So good evening and welcome to the webinar. And I guess we've seen a couple of weeks of roller coaster rides. And, every morning when you woke up, you had something different, right? So at times, I think by the time you slept, it was something else. And, we had a lot of things happen during, when the US was awake, right? So, uh, of course, now it's also come to a point where I'm just wondering, hopefully this has gone away, okay? Uh, and some of the issues that we have seen, okay, are hopefully, get addressed in a much better way. So to start off with, I thought, maybe basically uh, talk a little bit about tariffs. I thought we'll also spend a little bit more time around markets and what is the view, because I think most investors have been, wanting to know what our views are. Some have been apprehensive, some have been coming back and saying that, it's a good opportunity, why not invest? But what is it that we think, and to be considered, and what are the data points that we could look at to make a decision about what is it that we should be doing right now. And so to start off with the first section on the tariffs, why tariffs? Okay, I think the US trade deficits sort of have been ballooning, and which is why the US came back and saying, how do we counter tariffs, you know, uh, or bring trade barriers so that how do we counter trade deficits and bring trade barriers also to lower the deficit and especially with the rest of the world, if you see, including countries like China, and you would even find a lot of smaller countries as well where the US runs up huge trade deficits. And of course, I think one of the pet thing for Trump has been, around manufacturing and bringing it back to the US. Over the last few decades, US saw a lot of manufacturing move out into China and other countries, and that is something that Trump would like to see, and bring back to the US. And the tariffs then, sort of come back and uh, impact, other countries, and hopefully the expectation for the US is that, you will see the deficit narrowing and, um, you know, also their ability to export to other countries sort of increasing. Now, I also see it from another standpoint, and I think it's also to do with, I think, his understanding of market cycles, and because the U.S. economy already, has been trending and doing well, and possibly what some people feel overheated. Okay, so any growth from here needs to come from outside, right? So from that standpoint, for the U.S., if they could export, then it also adds to employment. It adds to being able to narrow the trade deficit, right? And what is it brings us back to what is the impact on India, okay? And so if you see annual exports to the US about $87 billion, okay, and if you exclude petroleum and pharma, then it is something like 72.5. Okay, so if you look at it from some of the reciprocal tariff number of 27%, then the impact will be something like 0.3 to 0.5 is what our estimation was. Interestingly, RBI's numbers also in its policy, sort of seem to converge, and they reduce the GDP, forecast by 0.2% from 6.5 coming down to 6.3. So that seems to be already baked into RBI's expectation as well. So that is something which if implemented, will have some bit of impact on India. But the good news is it's not too high. So you'll see that where all are we exporting to the US, and so you have the numbers there. Electrical machinery and equipment, 14 billion, pharma 12.5, and precious metals and jewelry and stuff like that is something like 11.6 billion. Okay, and so in summary, what is the tariff impact? In the short term, could be negative. Okay, and of course, we also have the overhang of the, whether some of this will lead to a U.S. recession. I believe in the short term, if things, don't get too volatile from here, and things don't get too uncertain for businesses, hopefully, the US will not see a recession immediately. But if volatilities and uncertainty more or less continues, then it is likely that US companies, US consumers, all push back their spending, and that could have a negative impact on the US. We also believe there are other impacts which are there, could be including supply chain disruptions. If tariffs actually are there, then it'll likely to slow down global growth as well. So that is something that one keeps in mind. Of course, from our point of view, at least personally, I felt from the initial time that there was talk on tariffs, I felt it was only a negotiating stance. Okay, that was taken by Trump to be able to start give a little bit of a jolt so that one can start renegotiating. Okay, and I think that they've been pretty successful at that. Okay, including the timing of it, and including how the postponement happened. Just the day that tariffs were supposed to come into place. So that is something which I think has created a platform for the US to be able to renegotiate. Now, what could happen? Again, if the tariffs are there, again you'll see inflation. Some sectors, especially like auto, etc., can be impacted there. Now, for India, again, one saw that as soon as the US started pushing for lower uh, duties on import of cars from the US to India. Now, some of the European Union as well have been coming back and pushing for the same. So that is something that could impact local industry. If in those specific sectors where we may not be as competitive on a costing basis, and that we have been shielded because of the custom duties that we levy, on imports. So that is something which is there, but I think the longer term impact could also be positive, because if broadly, globally, there's a lower tariff regime, then it may actually have the opposite impact. It may have the impact of, you know, uh, trade actually booming at a global level across countries as well. And lower tariffs could see a lot more of, global growth coming in from cross-border imports and exports. So that is something which is there. Of course, even if you look at, even if tariffs were there, you must keep in mind it's a relative game, right? So if there's tariffs on, let's say, India, right? And the question is, it's not just, okay, what is it, for India? Okay, costs go up by X% for Indian products. But what it does is, you have to go back and look at which are the other competing countries, or the countries with whom we compete for, our exports, right? And from there, let's say if it is China, if it's Bangladesh, if it's Sri Lanka, etc., Vietnam. Okay, so the question is now, what are the tariffs of those countries, right? If it's similar, then it may not have as much impact. It may not be possible for the US to immediately, replace and set up manufacturing facility and immediately, overnight have domestic manufacturing. So even if it is, lower to manufacture in the US, there is cycle time for it to happen. So the point of view is that, if it's a uniform one, it may not have as much impact. if even relative terms we are better off, then actually it may have a positive impact. So that's just one point that I wanted to make, while talking about the negatives and the potential positives out there. Okay, and you'll probably see as we go forward new trade agreements. I think what this will also trigger is, interestingly, I think there are some implications for the US also in the long term because of certain actions that they are looking at now and what many countries would believe is some bit of bullying. Okay, so I think in the long term, people will start looking at how do I, de-risk from the US, okay, and so that they don't come back and hold us to ransom in the future. So I think there will be a lot of trade which is likely to also get triggered between countries non-US and see how is it that they can sort of trade between other countries and have exports not just to the US but to other countries as well. So that, of course, so some of those will impact the US. Yes, there is also some bit of questions around the US currency. And I think, again, my view is that considering the point of view that Trump would like to bring manufacturing back to the US, I would also believe that the dollar, okay, in fact, they would intentionally, in my view, be looking to depreciate the dollar. Okay, and we've already seen some bit of depreciation in the dollar over the last few months. In fact, as Right Horizons, we had a negative view of the dollar, of course, including at times when it was really running up, and not too many people were sort of willing to listen to us at that point of time. But I think now dollar depreciation is a reality. The rupee appreciation also, we think, will be a reality. And if the Indian economy relatively does better, you will typically find that this will also continue, and the rupee will probably also appreciate versus other countries. The other huge benefit for India is due to lower crude prices and potentially lower interest rates as well. Okay, and that is something which will be a positive for India. Of course, in recent times, I think government has come in because we saw a bit of a slowdown in the October to December quarter. Okay, and it was very visible. So both in terms of the budget, in terms of lowering of taxes, that is something that will have a positive impact for India. And the central bank also has been cutting interest rates, has been infusing liquidity as well, both of which again are positive for Indian markets. So coming back to, so I think that's all I wanted to capture on Trump tariffs, and we'll probably take your questions also at the end of this session, and we'll also come back to what are the impacts, which is more important for us. Okay, what are the impact on markets, and what is the macro situation, and what is it that we think is likely to happen? So before I get into giving my views, I always like to see what is sentiment like. So I'll ask Tara to publish the poll. Okay, so basically we're talking about what is your expectation in 6 months. Okay, so because you do poll, will it fall by over 15%? Will it be flat? Or will it go up by 15%? So that is something that I keep doing this. I think even the last thing that I did probably in January, I asked a similar question, but of course this time I expanded the percentage. Okay, because there's a lot more volatility out there. So this is a thing that will give a few seconds to people to be able to complete their voting. Okay, in what is your view? What do you think? Where do you think markets will be, as we go forward? Okay, it's likely to fall by over 50%, 15%, or be in a range of -15, +15, or go by over 15, go up by over 15%. So I think we will start the poll and publish it. I think people are still voting. Okay, good. Yeah, so this is where we are. Okay, it's interesting that I thought the negative will be much more. Okay, I guess thanks to the pushing back It's been relatively positive. So only 15% believe it will fall by, over 15%. 65% believe it will be range bound between, say, minus 15% to plus 15%. And there's another 20% who believe that, it will go up by 15. So you have more bullish people in the room than the bears. Okay, so thank you for polling, and it just gives a bit of a perspective. Okay, so we'll move on into what our viewers like. One of the things that one has been talking about is, the dollar and uh, one parameter that, index that people look to is what is called the dollar index. The dollar pegged to the leading currencies globally. And what you can see is that the dollar has been appreciating right from, post-COVID days, and really went up very, very aggressively. But almost like if you look at it from uh, you know mid or closer to early 23 and mid 22, you will find that the dollar index had peaked. Interestingly, it was range bound for a period of time. Again, it went up. I guess around the U.S. elections, and now has been depreciating. And this, we believe, is a continuing trend, and there is something. Interestingly, if you looked at it, when Trump assumed office in Jan 2017, he was again working towards a depreciating currency. So if we go by that, it possibly is the beginning of, the depreciation. And possibly right now, one thinks that may be more aggressive than in the last time, because if you see his stance this time also has been a very, very aggressive stance from the last time that he was in office. So this is something that one keeps in mind. So if investors earlier, I think, were always saying, how do I keep money overseas? I think this makes a case for bringing some money to India, because then you'll probably see both maybe a better return for markets in India, but if you're an NRI, you possibly will see some benefit also from a dollar depreciation and the rupee appreciation. Uh, and coming back to dollar versus index versus MSCI emerging markets performance. Okay, so that is something that, and in India being an emerging market, that's why we are bringing this correlation. Okay, so what's interesting is it's a negative correlation. So basically, if the dollar depreciates, typically you'll find emerging markets sort of do better. So that is something which we think also may also lead to India doing well as we sort of go forward. The other indicator is very interesting, that gold, if you look at it almost like over 20 years, this is a ratio of 10 grams, Sensex by 10 grams of gold, okay, in rupee terms. So you will find that, despite good, typically an average 3-year performance is something like, 25, 26% of the Sensex in sort of this period of time. Okay, but if sort of you go back and see the Sensex by dollar, it's almost like it's come to less by 10 grams of Sensex by gold, sorry, 10 grams of gold is come down to less than one. So basically, it means that what we are trying to say is, just the absolute value of Sensex, right? And I'll just take round figure. Say if the Sensex is at 75,000 points, okay, and 10 grams of gold is also 75,000 rupees, then it is equal to one, right? So now, if the gold price, the denominator is, doing much better and goes to 80,000 of rupees, then, the Sensex by gold ratio comes down to less than one. And it's come down to a really low relative terms. Okay, so this is, and what does it tell us? Typically, if you see everything is cyclical, it also again points out to, in the long term that, possibly the Sensex is likely to do well from here. A lot of focus came in on for FI selling, and most people don't realize that whenever the selling has been very high, interestingly, just in subsequent quarters, you'll typically find FIs come and buy very aggressive. Okay, so and even if you saw, in this 20 2020 to 2024 period, you found that, there was, an extreme uh, low, in fact, possibly higher than the current one in terms of FI selling. And that was subsequently compensated by, 2024 doing, those good inflows that sort of came into from, foreign portfolio investors. So that's another. So what's interesting is if you look at data, right? It's sort of you see that a lot of them are pointing out towards, a relatively longer term performance. And of course, if you look at the Nasdaq, what is interesting that, if you look at it from September 24, the Nasdaq did much better, okay, and held on almost till Feb of 25, okay, and subsequently really fell off. Uh, for the Sensex, it has been almost like a drift, and what is interesting today, the Nasdaq has, which was delivering better than the Sensex has ended up falling more, in this period of time from September 24, right, to March 25. So that's something that one keeps in mind. Okay, so and if you look at interestingly, of course, the index in China did see a large fall. Okay, a drawdown from the peak. Okay, and interestingly, the market did well for some time. Thanks to the generative AIs. Some of the developments that happened around there in China, but thanks to being at the wrong end of its relationship with China, with the US, okay, and being at the epicenter of the Trump tariff, okay, it has done poorly. And what's interesting is India has fallen much lesser. Okay, so while we fell higher earlier, thanks to a little bit of weakness in the October to December quarter, okay, so we saw some bit of weakness in the Jan to March period of time. Okay, and so we have sort of done better. So that is something that one keeps in mind. We have fallen lesser, of course. The FTSE of UK has interestingly fallen lesser than India as well. But even the Nikkei, which is the Japanese index, okay, which had done pretty well, has also fallen almost double that of India. Okay, so and that the reason for that is this you'll find that the Sensex in the last 1 month has far outperformed most other indices across the globe. Index valuations, okay, we are very comfortable with the Nifty index valuation. We are sort of below the 5-year median P, and if you go back and see the one spot where valuations are a little higher is the mid cap 150, and I think two reasons for that. One is that and even the small cap, if you see, while it is 27.6, historically the index, the P has been higher, and so even there it is actually lower than the 5-year median P out there. The biggest thing was Nifty micro cap, which really ran up in recent times, has seen a very sharp fall. And I was saying that one of the index which has sort of held on and done better was the Nifty mid cap, and I would think because of, let's say, inflows into mid and small caps, you will find that their valuations are relatively been good, even after the fall, right? So, and if you look at it pre-fall, the Nifty 50 has almost like fallen from 25 to 20, and even the mid cap has fallen from almost 36 to 31, and uh, the biggest fall has actually come in from bigger fall has come in from the small cap, from almost like 39 times it has fallen to 27 times. So there has been a reasonable correction, and so our views, even if you look at it going forward across different market caps, you find that they now have almost come even. We will try and find the blue line as the 5-year average, and which is where most of them are. Okay, and either marginally higher or sort of marginally lower. So that sort of gives us comfort for uh, valuations out there. In terms of macro tailwinds are also benefiting, in, Indian markets, and you will find that the PMI manufacturing has sort of interestingly gone up to in March 25 to 58. Uh, and that's very, very good, compared to if you see all these periods of time. It's at the highest. The PMI on services has been uh, uh, sort of flattish, but also at the higher range of it. Okay, my IP, data is not yet out. Similarly, for the inflation side also, if you see it's sort of uh, gone into a lowering trend. What I think is, and a bit of a leading indicator for us actually is the GST, because if you see the GST growth was slower, between September 24 to December 24, right? So those numbers are lower, but and this to us may be a bit of a leading indicator for us. Anyway, between 12 say 9.1% to 12.3% in terms of year-on-year GST growth. So that also is sort of working toward recovery. But I still think, it still may not be a time to sort of completely go overboard. One still wants to see, how things evolve, because if, and maybe a phased type of investment may be a good idea over the next couple of months. So, but clearly, you can see that economic recovery is sort of underway, whether it's GST, the GDP growth, the capex spending that is also sort of coming up there. Uh, so we will have to wait and watch for the how the GDP how the earnings growth is for the last quarter of 25 and the financial year 25. So that's something that we'll be watching out for. Crude and dollar, I think, is something else that maybe will have some triggers. Of course, if the rupee appreciates, then some of the export-oriented sectors and technology, etc., can relatively see some margin erosion, due to that. Okay, but definitely crude under 70 is going to be, a big, big positive for India. I spoke of the GST collections, and this is where it is with small caps. Interestingly, small caps, see, one way of looking at the P ratio is looking at P by growth, okay? And what is the growth rate in earnings that you expect? So what's interesting that even though the P is at a number which is higher for small caps, okay, the growth in earnings is likely to be stronger, and because of that, when I just do a simple what we call as a PEG ratio, which is the P by growth, then you find small caps also not too bad to look at. Company updates, just to give you a flavor, so some of these are, it's not necessarily earnings, because I don't have too many companies which have come out with results yet, but if you look at it broadly, whether you look at retail, we look at something like the Hariom pipes, etc., some of the, including the small caps, and that's the point that we were looking at. We're seeing reasonably good, growth in revenues, etc. So I think that is something which is likely to play out. Of course, this is still early days, in terms of looking at results actually, and that's something that we will come to know over the next few, days. And just to summarize, what is sort of our view, and what is it that we're talking about in terms of both the impact of Trump tariffs. Okay, while there's been a lot of headlines around that. Okay, uh, we think that the 90-day postponement was always something that was planned for, and hopefully there will be a resolution by that period of time. But even if it's not the case and things are not able to be resolved favorably, then we think that the GDP growth impact is likely to be 0.2 to 0.3 negatively. But our bigger concern actually is the US. Okay, and the US economy and technology stocks. especially, some of the ones which have done very, very well in the US, including the AI ones. Okay, so that is something which I think we're suddenly seeing some bit of technological dominance that was there. We're seeing, China do very well and has made good strides, and I think has been quietly and strategically working on some of the areas which they believe in the long term are important, for them to maintain global supremacy, right? And so there's something that we think is a bit of an issue. We're also concerned about the US economy because typically after a very good period of economic growth, typically you see, and one of the data, the point that I keep, repeating is that whichever has been the country of a decade, typically, sees about 2 decades of pain. Okay, and in the case of China, it's in the second decade of pain. And if you also look at something like a country like Japan, which did very well, okay, almost 3 decades of pain. Okay, so that's something that, and why does it happen? It's just natural, economic activity, when things do very well. There's a lot of speculation that happens. People plan for growth, and excesses happen at that point of time. And what you call as a leveraging cycle typically goes to a peak, and it is followed by what we call as a deleveraging cycle, where companies who are borrowing earlier are suddenly looking at how do I reduce loans, to the extent of saying that I don't care whether it impacts my growth, but I have to survive, right? I have to reduce my loans. I am not able to repay. I'm not able to make ends meet. Okay, and that is something which it happens in the deleveraging cycle. India saw this in the previous decade when you saw four AAA rated companies directly go to default, you know, and there was a debt crisis at point of time. So to that extent, we are out of that deleveraging cycle and we are probably into a cycling of leveraging. So we are favorably placed, but we're concerned about the US. Of course, this is not a uh, such a short-term view that we are expecting, because the typical cycle is first, I think emerging markets do well, okay, and then you see, cycle turn. So that is something that, but this is definitely a risk on the horizon. And we are comfortable with Indian markets, their valuations and their, economic parameters. And after the current corrections, we think, valuations across market caps are hovering around their 5-year averages, and I think that's positive. Okay, and Indian earnings growth has been strong for a period of time. It saw a bit of a dip in October to December of 24, that quarter, and that was mainly because of slowdown in government spending. That slowdown in government spending happened because of elections in India, and in an election year, typically, you don't have a normal budget. You have vote on account, which is just keep the fire burning. Okay, and then subsequently, post the elections and post the actual budget, by the time projects get given out, etc., we saw a bit of a slowdown because of that. And the good part is, for us, initial indicators suggest us a bit of a revival in the Jan to March quarter, in terms of GST numbers, etc., sort of coinciding with that. Uh, and one of the reasons why we've not gone too conservative in our portfolios is that our portfolio stocks continue to show very, very good earnings growth, including in the October-December quarter. The many of our portfolio companies showed strong earnings growth. Okay, which is where we did not, we normally go, at contrary and go conservative, but this time we did not take a very conservative stance. And for investors who have liquidity, what is it that we would suggest? Okay, we think this is a time that you can look to make a phased infusion into markets. We're still not saying lump sum, but a phased investments over the next few months. Okay, to take advantage of market volatility, because I think there will still be, depending on how actions with respect to China take course, because that is something which can impact the US, and if it impacts the US, it's where we are keeping, just watching for maybe the next few days. Okay, this to be on the conservative standpoint. Okay, and that is something which is our point of view. But but definitely it's a period where, a disciplined investor come back and look at it and saying that markets are definitely lower. Okay. And it's good to, these such times, it's impossible to predict the exact bottom. So phase type of investment is something that one should ideally be doing to take advantage of market volatility. With that, I will, pause.